And can you guys see me? Is my webcam on? Okay. The stuff that we're doing on inventory is actually probably a bit of a review for you guys as well. The lower of cost and net realizable value might be new to you, as well as the retail method when we're trying to estimate inventory. But aside from that, everything is pretty much straightforward and from introductory accounting. So what I've done is I've resequenced this a bit. We'll just quickly go through the slides that they provided to us and look through what type of cost can be inventoried, and then we'll just refer into the handbook. And then I'll let you guys watch the example 5 in the PowerPoint on your own. So basically with that, we have two options. If we inventory it, then we're putting it on the balance sheet and flushing it out into cost of goods sold when we sell the item, or we just automatically expense it. So those are basically your two options when we're trying to decide what to do with the costs. Again, I think most of you already know how to do weighted average and FIFO. Specific identification is also another way that we could compute the cost of goods sold. When I'm talking about a perpetual and a periodic inventory system, that just depends on when we're actually counting the inventory. So when we look at those two costing formulas in PowerPoint problem 7, we'll go into the discussion about perpetual and periodic. Then we'll trace back and we'll go into the slides and look at lower of cost and net realizable value. And the only reason I do that is because this part, if I'm trying to think of the sequence, this happened last. So you inventory your costs, then you use perpetual periodic inventory system, then you either use FIFO weighted average or specific identification when you're reporting cost of goods sold. And then at the end of the year, before you put your statements out, we do one more measure, and then we look at the cost of the inventory and compare it to the net realizable value. And then we'll go with whatever's lower, and then we'll put our statements out. And then the estimation techniques, like I said at the beginning of or at the end of last class, usually a good way to think about this: if there was an earthquake or fire, you can't count your inventory. How do we actually estimate it? And so we'll show you two ways that we can do that. Okay, so let's just go to the inventory slide here. Okay, so we may as well just cover these two inventory systems right now. When I usually work with small companies like a bike shop or a retail store that's very, very small, Instead of counting the inventory every time you make a sale, what we do is we just do a count at the end of the year or the fiscal period. And so in that case, I'm using a periodic inventory system where I'm just doing an inventory count at the end, and then I'm making an adjustment into my financial statements before I send them out the door. Under a perpetual inventory system, you're actually using real time. So if you think about going and shopping at Walmart and whatever you buy, they're scanning it. The cashier is going to put a scanner through it, and then that scanner is technically taking the inventory out in real time. And it's super helpful too, because if you think of not only Walmart, but maybe even the Gap, if you go to one store and you're looking for an item and you can't find it in your size, you can just go to the salespeople and ask them which store has it. Then they can go into the inventory of all the other stores and then tell you which one to go to. So in that case, they're using the perpetual inventory system. So instead of me just reading off these slides, what I did is I just went into the standard and I double checked your notes as well, just to make sure that we know where to go to find out what items we can put in inventory and what items are just going to go through our income statement as an expense. So let's just go visit IAS 2. Now you're probably noticing that there's sort of two sets of standards. One is called IAS and one is called IFRS. So the reason why they're different is the IAS standards are just the earlier standards. And then I think they did go through a name change, and then now they're calling it the standards IFRS. So if you see IFRS, you know it's a newer standard that we're working with. So again, I'm just going to go into my folio and open up my CPA handbook. And I'm going to go under the accounting. We're using International Financial Reporting Standards, the 2015 edition, and the ones that are in effect at the beginning of 2015. So I said this was IAS Standard 2. So this is inventory that we're going to take a look at. And again, I referred to paragraph 9. So this is where we're talking about the types of costs that we can inventory. So you can just look through that on your own time. I'm not really going to talk about the gross method or the net method. I'm going to focus more on the different types of inventory methods that we're going to use. So if you want to actually see what they say about that slide, you can just go into Desire to Learn and just go back to the video where they're discussing that. With conversion costs and also with overhead, have any of you guys taken management or cost accounting yet? So that's part of a separate module. And so I'm just assuming, okay, some of you might have and some of you haven't. So I think this will make more sense after you take management accounting, because throughout the financial accounting modules, we usually, most of the time we focus on inventory where we buy a product and then we sell it. But with management accounting, what we do is we look at, instead of manufacturing a product instead and then selling it. So these type of definitions are definitely discussed throughout management accounting, but if you want to take a look at them, you can go to IAS 212 and 13, and then just get the definition off of that as well. So example 5, I think you're better off just looking at that on the video or trying it out yourself first and then doing it on your video. I really want to make sure we have a lot of time to look at the FIFO and weighted average under a periodic and perpetual inventory system. So I'll let you guys do this one on your own. So again, I said I was going to jump around. And here's where I want to land. So again, I think you guys might be on slide 79. I don't think I've added anything in here. Okay, so specific identification is pretty easy. And usually you think about it, if you go buy a Mercedes, then it's pretty easy for the car shop to identify specifically which vehicle you purchased. So in that case, what they're probably using is a specific identification inventory system where the inventory that they put in, or the car that they put in, is the same car that they're taking out and selling to you. And then they're recording that one as cost of goods sold. So whatever price they paid to make it ready for you, that's the price that they're going to remove out of inventory and put into cost of goods sold. So under this method, it doesn't matter if you're using perpetual or periodic system, it will be the same thing. So I don't think, we don't have any examples that we're going to do in class today, but they might have one or two in your notes if you want to look at it. So the other two that we're going to look at is FIFO and weighted average, and sometimes that's called average cost. Do any of you guys remember or have ever heard of using LIFO at all? Not FIFO, but we used to be able to use a LIFO inventory system. I'm just typing that in. So someone said, yeah, okay. So what happened when we harmonized with IFRS, we decided to take it out. It's not an acceptable method to use anymore, and it was never acceptable to use for tax purposes either. So they decided that we're just going to use either the FIFO or the weighted average. So the FIFO means the very first product that you put in the inventory is going to be the first one you're going to get rid of when you record your cost of goods sold. And so I like to think about this in terms of I go to the grocery store and I need to buy milk. So I just want to see, how many of you grab the milk from the back? Because you know they stock all the milk by their due date. So I always want to get the freshest milk. So I always reach for the back. Anybody else do that, or do you reach for the front? Yeah, okay. So those of us that go to the grocery store and reach for the back, you know you're using a LIFO inventory system, okay? Because they're moving all of the oldest products up to the front, and then if you reach from the front, you're using a FIFO inventory system, and that's what they want you to do, okay? So think of that in the same terms of stuff that we're putting in and out of our inventory accounts for these companies that we're going to be working with. And the good news is under FIFO, there's no difference in the amount that we record as inventory and the amount that we record as cost of goods sold under the perpetual and periodic inventory system. Then we can use a different one, and this is a weighted average. There is a problem though. When we do the weighted average calculation, we can take an average either at the end of the period under the periodic inventory system, or we can take a weighted average before you do a sale, and that would be under the perpetual inventory system. So under those two different methods, because we are taking weighted averages at two different points in time, we are going to end up with a different average per inventory unit. So in that case, they're not the same. You would have to do two different calculations depending on which system they want us to use, the periodic or the perpetual. And this will make more sense too when we actually go and work on a couple questions together. So I'm going to use Excel to go over this problem with you guys. And this is the same example that we're going to use. And we're going to do FIFO under periodic and perpetual system. And then we're going to do weighted average under periodic and perpetual system. And what I want to do is open up all my T accounts for inventory, sales, and cost of goods sold. because then you'll get a better idea of how things flow from the balance sheet over to the income statement. And then after we look at each method, we're just going to do a comparison under the 3 different scenarios and see the differences between what the inventory amounts are and then what the cost of goods sold amounts are, because that's just where the differences are coming from. So I'm just going to copy that information into here. Again, I don't know why, whenever I share my screen with you guys, it makes it a little bit grainy. So I hope by bolding all of this, it'll help you guys see it on your end. So I have the opening inventory, the sale number 1, purchase number 1, and I'm assuming that this is in chronological order because they didn't give me dates for this. Okay, and this is the number of units, and then this will be the cost per unit, or the price per unit if we're selling it. Okay, so it's 10,500, and I'll get rid of those zeros, and it's 425. Round that to 2 decimal places. So that's what I opened with. I make a sale of 7,500 units, and obviously I'm selling them for more than they cost because that's how you make your profit. Then you have a purchase right after that, and you purchase at $4.45. Then you have another sale that you make, and you're selling it for a higher price. And then you have another purchase, and you purchase that at $4.15. So let's take a look at this. And I want us to focus on using the FIFO method first. So I'm just going to call this FIFO, and we're using the periodic and the perpetual inventory system. So I'm just going to copy this first one down. So my opening inventory means this is how many units I had at the start of the period. That's the price. And then all you have to do is multiply the number of units by the price, and that gives you the total that's sitting on your financial statements. I'll just put a dollar amount there too. Okay, so now we can just go ahead and add up all the purchases on the left side and then deal with all the sales on the right side, and then figure out how much is in our ending inventory. So I'm going to pick up this first purchase of 2,500 units. I purchased those ones at 4.45. So if I just multiply those together, that purchase cost me $11,125. Then I can go and take the second purchase of 3,500 units, and I bought those at 4.15. So that means I purchased those at $14,525. So I'll just go ahead and add all this up. So if I add up all the units together, I have 16,500 that I can potentially sell. So you can't sell any more than what you have in your inventory. And if I add up the cost of all of those, in total, I have $70,275 sitting in my inventory account before I make the sale. So I'm going to go ahead and when you make a sale, what you're doing is you're removing the inventory out of the inventory account and you're moving it into cost of goods sold. And then you're recording the sales price. So I may as well going to do a T account for sales. And then right underneath that, I'm just going to do a T account for cost of goods sold. So we know where these are going. So if I'm selling 7,500 units, what I need to do is I have to get rid of these units first. And then once I sell all of those, then I can start working on getting rid of the next purchase. So in this case, because I'm using first in, first out, I gotta get the oldest inventory first. So I can sell 7,500 of that 10,500. So I'm crediting my inventory account, and then all I'm doing is I'm putting it into cost of goods sold. So now I have to look at the second sale. So 4,500 units. So I don't know, should I do all of the units at 425, or should I do the units at 445, or should I do them at 415? You guys tell me.